Assalamu alaikum everyone, welcome back to another video. I hope you're having a wonderful day. So in this video I'm going to focus on 5 companies that were asked by a brother on the Discord, and he recently wrote to me and just said, can you have a look at these 5 companies? So inshallah, that's exactly what we're going to do in today's video. Now before I get to the 5 companies, I want you to write on the comment section. I promise you, I'm sorry, but I've not had the chance to look at the comment section lately, but I will be inshallah, and I'm planning to put a video together to answer some of your questions. But what I want you to do right now is, what 5 companies or what companies that are on your watch list right now that you want to see, maybe we could look at in the next couple of weeks or so. So put it on the comment section. What companies do you want to check out? What companies are you interested in? What companies do you want to buy? Whatever it is, just put some names on that companies that you're interested in or you currently own and you want to learn a little bit more about when it comes to their financials and so on. Put it in the comment section and let's find out. Okay, so the more people that do, inshallah, the more we can get in terms of stocks that potentially we can look at in the future. The other thing I want to talk about today is just to let you guys know, I've got a few videos planned. Inshallah, we're doing an entire portfolio update in the next couple of days. We've received amazing dividend, alhamdulillah, this month. I'll share that exactly with you guys. I'm making some change to the portfolio as well. So inshallah, the next month in October, I'm gonna take a couple of companies out, reduce the portfolio and investments like 26 to probably about 25. There's one company that's definitely leaving the portfolio, and I'll share that with you guys as well. So there's a lot more inshallah to come. I've had absolutely crazy time in the last few days when it comes to busy time, not crazy time, really busy time. But inshallah I will be putting a lot more videos out in the next few weeks, if everything goes well, inshallah. Now all I ask you guys to do is like the video, subscribe. Okay, liking the video, subscribing to the channel helps, of course, reach out more brothers and sisters out there. And if you can, you'll pay about 15p per day to actually for the whole month, okay, to be able to get access to all of this, including the Discord basically benefits, where a lot of brothers genuinely, I don't contribute as much as I would like to rate lately. I admit that here. I'm telling you right now, I've not had the chance to contribute as much as I could should. But the brothers are sharing really good practices on what they do and what they buy in the news and all sorts of things. So if you want to join us, that community, we're trying to build a community of brothers and sisters like-minded that will help each other when it comes to Sharia compliant investing and so on. And you will see all of my buys and sells on here, the Discord. On the Patreon account side of things, you get the stock watch lists, you got the high quality companies that are put together, and on top of that you get the Sharia compliant investing ebook and so on. So if you can join us here, that will be absolutely amazing. Now let's get to these 5 companies we're going to talk about today, and the first one we're going to talk about is Garmin. This company is one of those companies that I've seen their product over whatever years, especially the watches and so on, but I've never paid too much attention into it. So I'm going to talk about it today because the brother asked us to look at it. Basically, the company, looking at their basically year to date, it's about 35% up. So that's really interesting. And now when it comes to current forward PE, we're looking about 28. So it seems a little bit expensive, but we're going to look at it in a bit. So for the 1 year, 68%. So if you bought a year ago, congratulations, you've done absolutely amazing job. Last 6 months up 17%. So based on this, it seems very expensive right now. And like I said, this company sells all types of products, including wireless device, okay, includes fitness segment, which includes the multi-sport watch that they have. That's the one that I've seen. They've got cycling products, apparently. They've got smart watches, which I've seen, monitors, fitness accessories. So they've got a lot of things, basically, the types of products. So it kind of more or less, is it regarded as a tech company? I'm sure it is. Oh, consumer electronics, there we go. So it's consumer discretionary, but in the consumer electronics side of things, right? Currently has a 33 billion market cap. It has a narrow economic mode, and price right now is $173 per share. Dividend yields of 1.7%. I didn't actually think they paid dividend, but they do. Payout ratio 49%, which is not bad at all. Latest increase was 3%, and the 5-year growth rate of 7%. Now they have not increased this for a long time, so 0 at all. So it's one of those companies, they will increase 1 year, the next year they might not, depending on So they're not really worried about the dividend streak. They're more worried about maybe increasing that dividend, which is nice. 7% is not bad for the last 5 years. Now, in terms of annually what you get $3. Safety now 79% according to Simply Safe Dividend, which is fine. They grew up that revenue over the last 5 years about 10%, 6% when it comes to EPS, profit margin 20%, and return on equity of 21%, which is really good. Return on invested capital 17%. Now that side of things really good. Profitability side of it, what the company, the management is doing with that money that we investing with them. The free cash flow right now $1.3 billion, which is really good for a small company like this. And the free cash flow compound annual growth rate for the last 5 years, we're looking at about 16%, which is really good. Total return in the last 10 years 14%. Growth estimate next year 9%, 10% every year from the moving forward. Really solid. But it seems very expensive right now. So 16% premium right now, $128 per share is where they think the price should be. Right now we're looking at 173. Now if we go back here and look at Seeking Alpha Wall Street, what they're saying, we got 1 strong buy, we got 5 holds and 3 sales. Now their price target for this company is $167 per share. That's about 3.5% downside from where we are right now. So, and the earnings expectations, let's see where we are. So about 8%, 9%, 7%, 8%, 11% after that. So if you focus on the first 3 here, you're looking at about 8-9% every single year in terms of EPS. Revenue is growing really nicely this year, top 14%, then 10% after that, almost 9%, sorry. Almost 9% after that year. So interestingly is doing well in terms of the revenue side of things. EPS also 8%, so on. So it's solid business, but it seems really like a little bit expensive. So I would definitely wait for a pullback before actually buying that company. Right, the next one is Intuitive Surgical. We've talked about this company before. The company is in the healthcare side of things. I think they've got something called the Da Vinci. What is it called? Let me see, because I remember once looking at it. The company offers it, there we go, the Da Vinci surgical system that enables complex surgical using minimum invasive approach. Again, so anything to do with surgery side of things, they're a healthcare company. They do a lot of the healthcare equipment side of things. Right now, in terms of price wise, for year to date 64%, sorry, for the 1 year 61.4%, but when it comes to year to date 42%, last 6 months about 19%. Current PE very expensive, forward PE 72 right now, which is absolutely crazy. But they do have of course a positive EPS, which is quite nice. Now market cap 173 billion market cap. It has a wide economic moat. Current price 470, let's call it 480. But they don't pay any dividends, which is fine. On the last 5 years, they grew that revenue about compound annual growth rate of 13%, 10% when it comes to EPS, profit margin 27%, return on equity of 15%, and return on invested capital 13%. So absolutely solid. 419 million when it comes to free cash flow. Now they have a negative free cash flow compound annual growth rate for the last 5 years, and so it's slightly declined about 16%, which is not great. It's not slightly. Total return the last 10 years we're looking at about 25%, so which is absolutely amazing. Growth estimate next year 15%, 14% up after that. It's absolutely amazing. 83% premium right now. That's absolutely crazy. $265 per share right now is double that, 480 almost, which is absolutely crazy. So it seems very expensive. Let's go back and see what Wall Street are saying. Normally they're bullish on this type of businesses. 14% of them are saying it's strong buy, 8 buys, 8 holds, 1 sell, strong sell, 1% upside from where we are, $483 per share. Now moving forward, earnings expectations 16%, 15%, 17%, which is really good. Double digits are there. Again, when it comes to revenue, again, double digits every single year. So that's probably why people are paying very high when it comes to very high multiples. Now, I want to check the revenue side of it. From $2 billion in 2014 to right now, $7 billion. So 2.1, 2.3, 2.7, 3.1, 3.7 billion, 4.4, 4.3. So a slight decline in 2020, which is fine, and that happened a lot. 2021 5.7, so massive jump there. 6.2, 7.1, and 7.5. And look at this, the cost of that is actually quite small. So they've taken home gross profit of $5 billion. They're paying for all sorts of things, so almost $2 billion operating income, and then it's all sorts of interests and so on, and then that net income is about $2 billion. How much do they have free cash flow right now? 400. So I'm not sure why that is declining, but there you go. So that's basically what the company has reported. And in terms of earnings expectations, EPS for the last 10 years, we're looking at about $1.26 to right now $5.93, which is a nice growth there as well. The third company we're going to talk about today is one that we've recently analyzed, and that is Carlisle Companies. This is a company that sells home products. They do sell stuff like roofs and so on for the houses and so on. So right now they've got about 20 billion market cap, wide economic moat. Price right now is $444 per share. Dividend yield just less below 1%. The payout ratio only 18%, which is quite nice. Latest increase was 18%. Okay, and then when we look at the 5-year growth rate, we're looking at about 18%, which is 16%, which is really good. 47 years of increase in that dividend. Annually, you get $4 per share. Safety 99%. The 5-year growth rate when it comes to revenue is not really there. When it comes to EPS though, 41%. Profit margin, return on equity, and return on invested capital, really good. $1 billion of free cash flow. 18% when it comes to the free cash flow for the last 5 years, which is really nice. 19% total return, which is huge for this company. Very small company as well. 13% in terms of growth and expectation for next year. 15 after that. 22% premium right now. $59 per share is where they think the price should be. Now, according to this, the quant is saying it's actually strong buy. Wall Street is saying it's a buy. So 3 strong buys, 1 buy, and 2 holds here. About 7% upside from where we are. 477. Look at the earnings expectations moving forward. Wow, 32%, 12%, and then 7%. 11% in terms of revenue, 5% and 5%. So that's absolutely huge. I don't know if they acquired another business, but if that's organic or not, but will be interesting to dig deeper and find out a little bit more information of the company. Now, in terms of revenue, 3.2 to 4.9, $3 billion of cost of that revenue, $1.8 billion of gross profit. They've done a lot of things, and then here we go, $1.3 billion from taken home from basically 4.9. That's not bad at all. That's really good. So they're keeping about $1.3 billion from that $4.9 billion that they've made, which is absolutely fine. So there you have it. That's the third company. The fourth company we're going to talk about today is Canadian Natural Resources. This company is I couldn't find any information, by the way, from Morningstar because they don't have any valuation for this company. So I'm using Wall Street, simply Wall Street for this one. Okay, this is a Canadian Natural Resource company, 70, so oil company if you like, 70 billion market cap right now. They don't have any moat at all. A lot of the oil companies really don't. $33 per share right now. Dividend yield of 4.5, which is absolutely huge. 50% when it comes to payout ratio. Latest increase was 5%. The 5-year growth rate 23%, which is absolutely huge. 22 years of increase in that dividend. And then when it comes to the payout, you got what, $1.52. 70% safety, which is really good. The 5-year growth rate for the revenue side of things is 12%, and then EPS minus 20%, which is not great at all. Profit margin, return on equity, and return on invested capital, really good. $7.7 billion of free cash flow. 17% when it comes to the free cash flow compound annual growth rate for the last 5 years. Total return 7%, 12% growth estimate for next year, minus 1% after that. According to simply Wall Street, 42% up, basically upside from where we are, undervalued by then. $59 per share is where they think the price should be. Now, looking at how the company has performed, just 1% for the year to date, almost 1% when it comes to 1 year. Now, if we look at the Wall Street, we've got 9 strong buys, 4 buys, and 10 holds. And they are saying all of them are basically quant. Wall Street and Seeking Alpha are saying all is a buy. Now, that's about 19%, 20% from where we are right now. $39 per share. Now, if we look at the earnings expectations moving forward, it's a minus 7% this year, but then nice double digits for the following 2 years. And revenue side of things, 3%, minus 3%. Is oil companies, very cyclical, so that's kind of expected. Now, revenue side of it, $16.2 billion to right now $26 billion, so that's about 10 billion. Grew about $10 billion for the last 10 years. $13 billion of basically cost of revenue. $13.8 billion of gross profit. They've done a lot of side things, and then here we got the $5.6 billion of net income, which is absolutely fine. So yeah, there you have it. That's the fourth company we're going to talk about today. And the final company we're going to talk about today is Halozyme Therapeutics. This is a company that I've never looked at. Very, very small, less than 10 billion market cap, 5.7 billion market cap right now, narrow economic mode. This company sells, basically it's a healthcare company. I believe it's a biotechnology company. Again, I don't like touching these companies because they are very, very volatile, but we will look at it in a second. In terms of white mode, it doesn't have a white mode at all. $56 per share right now, no dividends whatsoever. In 5 years, we're looking at about 37% compound annual growth rate, and then the EPS, we're looking at 56%. Now, this tells me this is a very fast growth company. Again, probably very volatile. We'll look at the charts in a second. Profit margin 28%, 153% when it comes to return on equity. On return on invested capital, 22%. I like the fact that it's very profitable and management are doing a good job. $400 million free cash flow right now, 62% when it comes to that growth of that for the last 5 years. Total return in the last 10 years, 20%, and growth estimate next year, 19%. Expected to grow about 28% basically the following year, basically for the following 5 years, which is absolutely huge. Fairly value right now, according to Wall Street, $52 per share is where they think the price should be right now, 56. So not bad at all so far. Now let's have a look at a few things. Okay, the 1 year we're looking at 48% growth in terms of the prices. 54% when it comes to year to date, which is absolutely amazing. So if you own this stock for the last whatever, you basically since the beginning of the year, well done to you. Last 5 years, 274%, and when it comes to the last 10 years, 528. Now let me see how long this company existed. How long have they been around? Oh wow, it was in 1998. So they have been around for quite some time. Okay, and like I said, it's a biotechnology company. They do a lot of things. I'm not into this. I'm not a doctor, so I wouldn't be able to tell you exactly what the company sells and how if there's a demand for their product and so on. But looking at valuation side of things, we're looking at 4 strong buys, 3 buys, and 4 holds right now, and 7% upside from where we are. So they're saying about $61 per share. Now, the bit that I'm interested in, the growth expectations moving forward, 43%, 19%, 32%. So if we just focus, and there's quite a lot of people looking at, so next 3-4 years, they're expecting nice double digits every single year in terms of EPS and as well as, of course, revenue side of things. So they're really, really interesting. Now, let's go to financials and see how they're doing from this side. So we've got revenue of 75 million to 873 million. They taken home 619 million. Okay, so they were making a loss for quite some time, and then they now have got nice gross profit. Okay, I want to see their net income of the whatever last few years. So they were losing, and a couple of years of positive net income. Okay, then looking at EPS, the basic EPS, so they were losing money. Then 2017 they became positive. Then they start losing money again, and this is why I stay away from this type of businesses, because it's there's no pattern, and I know it's still small company, and I'm sure we will do well over the whatever years, but this is not the type of business I want to invest in. Now looking at valuations for the last 5 years, so if we look at the average, so if we look in the PE, okay, so we're looking at non-GAAP side of things. Okay, this looks like that's what they normally report. They don't report GAAP here, which is interesting. So about 19 right now, it's about 17, so it's cheaper. It seems cheaper in terms of that. And what about PEG ratio? Okay, so the current PEG ratio is below 1. That's interesting. So that tells me that it might be a little bit cheaper. In fact, let's go here and go to Halo. I want to see exactly if that information is accurate, so I'm going to go statistics here, and let me see in terms of PEG ratio. They don't even have any information for the PEG ratio for seeking out monies. Yahoo Finance. Anyway, so that's the company. I'm not sure how I feel about this one. The other 4 are really good businesses, and they seem to be. I was interested in this one. I think I'm still. If I need to add maybe another crude oil company and so on, I'll potentially be looking at this one. I like the dividend side of things. I like the fact that they've got nice free cash flow. Seems undervalued at the moment. This one I was really interested at some point, but it seems it's still very expensive, so I'm gonna leave it alone. This one is really good. I think I like the product. I would have to do a little bit more research to see if there's demand for their product, who their competitors are, just a lot more to come. So if you're interested in these companies and you wanted me to do a little bit more, dig deeper, maybe do the single videos for them, let me know, inshallah, on the comment section. But that's the 5 companies I want to share with you guys. And from Sharia compliance side of things, that's it. That's all from Zoya standards that we normally look for, and nothing to worry about. This one is the only one that's got high interest bearing debt, but the rest of them are absolutely fine, so nothing to worry about. But there you have it. That's the 5 companies I wanted to share with you guys. If you would like me to look at individual stocks that you have on your watch list, please put it in the comment section and I'll share my thoughts, inshallah. Have a wonderful day. Assalamu alaikum.